All right, let's talk about Plug Power. The hydrogen fuel cell company has been on an absolutely wild ride, and a new technical report might just give us a roadmap for what's coming next. So let's dive in and break down the signals. After a pretty sharp recent drop, this is the big question on every investor's mind, right? Is this just a healthy correction, or are we looking at the start of a real collapse? The technical charts, well, they're giving us some serious clues. And this is the number that really got everyone talking. On November 14th, the stock just plunged over 9.5% in a single day, and on high volume too. A move that big, it really grabs your attention and makes you wonder what is actually going on under the hood here. So to understand that drop, we first have to see where the stock is standing right now. And according to this report, the picture is, well, to put it mildly, pretty bearish. Just take a look at this for some perspective. At $2.25, the stock isn't just down, it's trading way, way closer to its 52-week low than its high. This tells you that the negative momentum isn't something new. It's been building up for a while now. The report uses this interesting metric called a risk thermometer to kind of quantify this feeling. A score of just over 30% puts the stock squarely in the bottom third of its yearly trading range. This just confirms what we were just looking at. The bias right now is clearly pointing down. Okay, so we've pretty much established the what is going on. Now it's time for the why. Let's start decoding the specific technical signals that this report is flagging as so critical for Plug Power at this very moment. And this chart really gives you the big picture at a glance. A whopping 70% of the technical indicators are flashing bearish signals. Only 10% are bullish. The rest are mixed or, and this is interesting, oversold. We'll definitely come back to that. But wow, that 70% figure, that's a powerful headline. First up, moving averages. You can think of these as just smoothed out trend lines for a stock's price. The report confirms that for Plug, the short-term averages have dipped below the long-term ones. That's a classic technical signal that folks call a bearish crossover, and it really reinforces that the downtrend is very much intact. Now let's circle back to that oversold signal I mentioned. This comes from something called the Relative Strength Index, or RSI. The best way to think about it is like a rubber band. If you stretch it too far in one direction, it's probably going to snap back. Well, the report notes that Plug's RSI is low, which suggests the selling has been so aggressive that maybe, just maybe, the stock is due for a short-term bounce.
But here's the crucial point. It's not just one signal pointing in one direction. The report groups them together, and they're all telling a very similar story. Trend indicators, they show a strong downtrend. Momentum indicators, they point to that trend continuing. And the volume indicators, they suggest more money is flowing out of the stock than in. It's really a trifecta of bearish signals.
And all of this, it all builds up to the most critical part of this whole analysis, the key price levels. You got to think of these as the lines in the sand, where the fight between the buyers and the sellers is either going to be won or lost. And here they are. The stock is sitting at $225. Now, the bears are trying with all their might to push it below the floor or support at $216. If they can do that, the price could fall even further. The bulls, on the other hand, they need to smash through that ceiling or resistance at $242 to get back into control. This quote from the report just highlights how urgent this is. The stock closed just 9 cents above that critical support floor. That is a razor-thin margin. It means a real test of these levels is probably coming very, very soon. The battle is right around the corner. So, given this whole setup, the analysis points to 3 pretty distinct paths forward from here. You've got the bullish, the bearish, and the neutral. Let's break them down. First, the optimistic case. This scenario really hinges on that oversold RSI we talked about, that stretched rubber band. The idea here is that the selling pressure is just exhausted. Maybe a little bit of good news hits. Buyers see a bargain and they rush back in, causing the stock to bounce back hard. The key trigger here, the event that would prove the bulls are right, would be a decisive break above that 242 resistance ceiling. If that happens, the bulls are back in the driver's seat. But the bearish case, on the other hand, is that the weight of all those negative indicators is just too much to overcome. You've got those fundamental concerns mentioned in the report, things like margin pressure and delays in hitting break-even, and they just keep a lid on any optimism. In this world, the sellers stay in control, the price breaks below that critical 216 support floor, and the door opens for an even further slide down. And then you've got the third option, a stalemate. Here, the buyers and sellers, they essentially fight to a draw.
The volume dries up, the conviction on both sides just kind of fades away, and the stock gets stuck in the mud, chopping sideways around that 233 pivot point. It becomes a waiting game where the market is just looking for the next big catalyst, be it major news on hydrogen tech or something in the broader energy sector to force a decisive move one way or the other.
So, after weighing all these indicators, all these possible scenarios, what's the report's final verdict? Where does it all land? Well, the analysis condenses everything into this single technical score, 45.83. And as you can see, that's just a hair below the neutral threshold of 50. This really confirms the overall takeaway. The stock is technically weak, it's leaning bearish, but it's not in a complete nosedive. It's right on the edge. This final quote, I think, perfectly captures the delicate balance here. On one hand, you have the company's long-term plans, which offer some real hope for a rebound. But on the other hand, its high volatility, what they call high beta, means investors really need to be extremely cautious right now. It's a classic case of potential versus peril. Which really leaves us with one final big question. The technical charts are flashing some clear warning signs. But let's be honest, charts only ever tell part of the story. The real question is, what kind of fundamental news, a huge new partnership, a technological breakthrough, a major policy shift, what could be powerful enough to just override all of these signals and send the stock flying in a completely new direction? That right there is the wild card everyone should be watching for.